Good morning. Today we are going to talk about demand for labor. This chapter is divided into two main parts. The first part is related to demand for labor in the short run, and this is what we are going to do today. And next time we are going to talk about demand in the long run. Actually, demand for labor is a demand, derived from the demand for the commodity itself. As people demand the commodity, as a result, firms would like to increase production. As a result, firms will demand more labor. So this means that demand for labor is derived from the demand of the commodity itself. As we said in last lecture, that there is a negative relationship between the quantity demanded of labor and the wage rate. Just like the law of demand for a product, there is a negative relationship between the price of the commodity and the quantity demanded of this commodity. The same with respect to demand for labor. There is a negative relationship between number of workers demanded and the wage rate. And last time we explained the income effect and substitution effect in order to understand how this will affect the demand for labor. In this chapter, we will identify assumptions that explain this relationship. So mainly this chapter focuses on identifying the assumptions that explain this negative relationship. The main objective of any firm is to maximize profit. So profit maximization is the basic assumption of the theory of demand for labor. As the main objective of any firm is to increase profits or mainly to maximize profit. In order to do this, firms are assumed to ask one main question. Which is, can we make changes that will improve profit? So this means that firms will focus on increasing inputs or increasing factors of production if change will cause an improvement in profit, whether this change can be by increasing or hiring more workers, or vice versa, by laying off workers in order to decrease costs and increase profits. There are two main points we have to notice. Number one, firms can make changes only in variables that are within its control. This means that firms cannot affect the price. As we said before, that firms are price takers, or prices are given, whether prices of factors of production or prices of the product. For each firm alone, prices are given. So this means that firms has no control over prices. So we have to think about whether and how to increase or decrease output. Prices are given, so what are the other factors that's under the control of the firm in order to be able to increase or decrease output? Point number two. Firms are seeking or searching for profit improving possibilities. In doing this, focusing on profit improving possibilities, firms have to think about small changes, or in other words, marginal change. If you are going to produce one more unit, if you are going to add one more worker, so in case of improving profits or increasing profits, they have to think about the marginal, the additional unit, whether with respect to hiring individual, buying machine, or with respect to selling this unit in the market. With respect to employment, of inputs, marginal changes mean a small change in one input. So this means that we are going to change labor while holding other factors constant, or changing capital while holding other factors constant, and so on. So once again, we would like to increase labor while keeping capital constant, or increase capital while keeping labor constant. What is the optimal level of output? Firms would like to identify the optimal level of output that achieve the main objective, which is profit maximization. Optimal level of output if the firm wants to increase output by 1 unit, okay, so optimal level of output, if you are going to talk about the idea of the marginality. In case of optimal level of output, this means that you would like to increase production by 1 unit. In this case, we have to think about factors of production that will be used in order to increase this unit of output. So, if firm wants to increase output, this will happen if the added revenue from selling that unit is greater than the added cost of producing them. So once again, we would like to identify optimal level of output. In this case, if you would like to increase production by 1 unit, you can do this if the added revenue from selling that additional unit is greater than the added cost of producing them. So in other words, added revenue, if added revenue is equivalent to added cost, so there isn't any possibility to increase production, as this is going to be the optimal level of output. We can write it as marginal revenue equals marginal cost. Added revenue is the additional revenue, which is the marginal revenue, and the added cost is the marginal cost, or the additional cost. So this can be summarized as you can increase production when marginal revenue is greater than marginal cost, or decrease production if marginal revenue is less than marginal cost. Keep production level constant when marginal revenue equal marginal cost, and this is the profit maximizing point. A firm can expand or contract output only by altering its use of input. And we are going to assume that production depends only in 2 main factors of production, which are labor and capital. So this means that production depends on labor and the capital only, without any other factor of production. So in order to identify whether to increase the number of units used of labor or capital, we have to rely on the marginal concept, the marginality, the idea of the marginality, or the marginal rule. What's the marginal rule? Marginal rule states that if the income generated by employing one more worker, by employing one more unit, whatever the factor of production, whether it's capital or labor, is greater than the additional expenses of adding this unit of factors of production, so you can add or hire one more worker. Okay, so just like the production, with respect to production, in order to increase production, if it is you're gonna be able to increase production if marginal revenue is greater than marginal cost. This is the same idea. If income generated by employing one more unit of an input, this is known as marginal revenue product, is greater than the additional expenses generated from adding this input, so more inputs can be employed. You will reduce employment if marginal revenue product or marginal income, additional income generated for this input, is less than marginal expense income, additional expenses. And finally, there is no change in the employment level if marginal revenue product is equivalent to marginal expense income. Now we have to understand what's meant by marginal revenue product, marginal expense income, and so on, in order to identify the profit maximizing condition. Let's start with the marginal income from an additional unit of input, which is marginal revenue product. Employing one more worker or adding one more unit of input generates additional income. This additional income is generated from these additional units will be used in order to increase production of goods and services. Goods and services produced by the additional unit will be sold in the market. So employing one more unit generates income. This income is generated as this unit will help the firm to produce additional units of goods and services. These goods and services will be sold in the market. So this is the income generated by the additional unit employed. So we can define the marginal income from additional unit of input as fund it is the income which is generated by multiplying revenue generated per unit of physical input. Okay, sorry, it's revenue generated per unit of physical input multiplied by a change in physical output produced. Example. If you are going to hire an additional worker, this worker helps to produce 20,000 units of output of any product. A unit of output will be sold for $25. So the marginal income generated from this additional worker will be calculated as $20,000, which is the number of units produced by this worker, multiplied by price per unit sold in the market. So the total marginal revenue of a product will be 500,000. So this is the marginal productivity of labor. And this is the marginal revenue. So this means that marginal revenue of a product, so the marginal revenue product will be calculated as marginal productivity. If it's marginal revenue product of capital or product of labor, so it's marginal productivity of labor or capital based on this is marginal revenue of what? Multiplied by the marginal revenue. So now we have to explain the two main components of marginal revenue product, which is marginal revenue and the marginal productivity. and how to calculate each one of them. Marginal revenue is the revenue generated by an extra unit of output, and it depends on the characteristics of the product market. What's meant by the characteristics of the product market? This means to identify whether the market is a competitive market or has some degree of monopoly. Perfectly competitive market, or there are some degree of monopoly. If it is perfect competitive market, in this case, the marginal revenue generated from the unit sold is equivalent to the price of this unit. While in case of marginal revenue, in case of some degree of monopoly, so in this case, marginal revenue will be less than the price level. What about, this is with respect to marginal revenue. What about marginal productivity? Marginal productivity in general is the change in output due to increasing input by 1 unit. So marginal productivity of labor is the change in quantity produced or change in output divided by a change in labor while keeping capital constant. And with respect to marginal productivity of capital, it is a change in quantity divided by a change in capital, keeping labor constant. So we can write the marginal revenue product of labor as marginal productivity of labor multiplied by marginal revenue, which is equivalent to the price. So marginal productivity of labor multiplied by price instead of marginal revenue. And the same with respect to marginal revenue product of capital. It's marginal productivity of capital multiplied by marginal revenue, or marginal productivity of capital multiplied by the price. This is with respect to marginal revenue or marginal income generated from employing an additional worker. What about the marginal expenses? Marginal expense of an additional unit or of an added unit. Say, for example, marginal expense of labor. This can be written as marginal expense input. Okay, so marginal expense of labor is the expense that's incurred by hiring one more labor and it's also affected by the nature of the competition in the market, in the labor market. Whether it is competitive, perfectly competitive, or there are some degree of monopoly. Just for now, we are going to focus on competitive labor market. In this case, each firm is wage taker. As we said before, that in case of supply, wage rate will be horizontal for each firm alone, while for the whole market will be positively sloped. So in this case, marginal expense of labor will be equivalent to the wage rate. And the same with respect to capital. Okay, next time we are going to talk about short-term demand for labor when both product and labor markets are competitive, and long-term, long-run demand for labor when both labor and capital market are competitive. This is the end of our lecture today. Thank you and see you next week.